Government spending could outpace revenue in the next 3 years. Now, that's basically spending more than we earn. Giving this grim projection, the Finance Ministry says that it also assumes there won't be further policy moves in future, which would need additional revenue to balance the budget. Tan Se-hui with this report.
An aging population, changing lifestyles, and higher manpower cost. These are some of the factors that are escalating a key driver of Singapore's expenditure, healthcare spending. It's projected to soar to around 3.5% of GDP by the end of the decade. Also taking their share of the pie, expenditure that's already been committed to improve early childhood education and to uplift lower wage workers. These will see government spending increase in the second half of the decade to around 19 to 20% of GDP, or even more. The ministry says that's why the tax changes announced in last year's budget were needed to close the gap. These included the rise in the goods and services tax to 9% and an increase in the top marginal personal income tax rate. But additional revenues may still be needed to balance the budget, and a wealth tax could be one new revenue stream, according to economists.
There are many far more wealthier people coming and live and work in Singapore. There are far more wealthier Singaporeans. And this is where accumulation of assets can be, a source of further revenue from a government standpoint, taxpayers' standpoint. So these are some of the areas that perhaps we can tweak it.
But moderating expenditure will be challenging with an aging population. They say keeping Singaporeans active and healthy, as well as investing in people through training and upgrading, could help manage cost.
That dollar that I spend today, I invest today, leads to returns for the future, right? And that could cut down the amount of future spending that we might have, and the trajectory of future expenditure, all the way out to 2030 and beyond, might be lower than we currently budget and currently expect, because we've spent that money early on.
And despite the challenging global headwinds, the economists remain optimistic on the investment front. The Finance Ministry also projects that net investment returns contribution will keep pace with economic growth at around 3.5% of GDP.
For all this, we speak next to Professor Sumit Agarwal. He's Professor of Finance, Real Estate and Economics at NUS Business School. Professor, we just heard from that report an analyst suggesting that the accumulation of assets can be a source of revenue that we can then, the government can then tap. Now, of course, wealth taxes, always a potentially sensitive issue. But is this expenditure outrunning revenue enough of a problem for us to be thinking of actually tweaking our wealth taxes in Singapore, introducing in the first instance?
I don't think so. I think we should have wealth tax on immobile or illiquid wealth like real estate. But liquid wealth like family offices, those things they can just fly away very quickly. And then we lose employment, and we lose, many other aspects of the attraction Singapore has. So I don't think we should be charging liquid wealth tax. I think there are other ways we can tackle this problem before we get and start thinking of a wealth tax on liquid wealth.
Professor Agarwal, the net investment returns contribution currently sports about a fifth of government spending, but in the longer term, future investment returns, they are expected to grow more slowly than before. Are there other tools in the government's arsenal, perhaps, that they can use to raise revenue?
Yes. So I think first we should think about income tax on the higher income earners. The government did that already in the past, but I think the income tax on the highest income earners in Singapore is still very low. So raising that by another 1% or 2% is not a bad idea. The other ways we can think about is we have to be thinking outside the box. We have to make Singapore a sustainable economy. So a sustainability tax, like a carbon tax, not just on a very select few large corporations, but a broader set of corporations that are actually having carbon footprint, or even thinking more broadly on consumers or small businesses that have a big carbon footprint, we should think of a carbon tax.
Professor, Now, even before GST was raised by the 1 percentage point this year, and of course the second raise will be early next year, we were already hearing from authorities suggesting that even when we go ahead with this increase, revenue may still not be enough in the next 10 to 15 to 20 years to match our expenditure. Why? What more? I mean, you were saying there are other ways we can look at, other means that we can tap. Apart from this income tax, as you mentioned, what else can we be doing?
I mean, I think GST was fine. I mean, raising from 7 to 9%, still GST is very low compared to other countries. But I wouldn't say GST is done enough. I mean, we don't want to, because GST can hurt the lower income individuals significantly, the higher income. So we should be progressive in our taxation. So income tax is a very good way, actually immobile wealth, which is like housing, especially on the rich higher end. We should tax that before we should think of other ways of taxing. And obviously carbon tax on corporations. So I think GST we have done 9. I think that should be enough. So going forward, I would say don't do more GST hikes.
It's been explained to us that the spending that we have on healthcare, that's rising. There are already commitments to education and expenditure on programs there. Is there any way of tweaking those or supporting those that could cut costs in any way?
Yeah, cutting cost is always difficult, because these are like big ticket items like defense, obviously healthcare, education, and many other things that are necessary. And that's the role of the government. But Singapore government over the years does give out a lot of freebies or goodies to consumers and households and even businesses. I think those could be cut down. I mean, in the last 2-3 years, they were kind of necessary due to COVID. But going forward, there should not be a reason to giving, various stimulus packages to various segments of society unless it's very necessary. We should do that. And that's one way we can reduce spending.
Professor, final question here. Of course, we have budget 2023 coming next week. As you mentioned, many analysts already expecting that these goodies, these handouts, these freebies will be very much cut back in the next budget. But are there any bigger moves you're expecting that will increase revenue significantly or cut expenditure significantly?
No, so I would start with just these, as I said, freebies. I mean, let's start there. Let's see, because we are still, the society is still experiencing higher inflation, so we want to be careful this year. But going forward, the government should be giving a signal that both we want to raise revenue through higher income tax or carbon tax and other things, but we also want to be reducing expenditure through some of these other programs that we have been doing in the last 3-4 years because of COVID and inflation. And so we will be looking on both fronts to make the economy or the balance sheet balance on revenues and expenses.
Thanks so much for joining us this evening, Professor Sumit. Thanks for those insights. Professor Sumit Agarwal from the NUS Business School.